Hi, everybody. I'm John Smith, General Partner with Innosphere Ventures, leading the B2B software practice. I have over 30 years experience founding and building software businesses, taking them from scratch to over $100 million in annual revenue. Now I'm a venture capitalist, ready to guide you on your journey, helping you build your successful B2B SaaS business. Today, I'll be talking to you about how to raise money to start a business. So, how do you raise money to start a new business? Well, to get started, as you're establishing your business and your product market fit, you should use bootstrapping, friends and family, or angel funding. Once you've established some traction and are ready to raise more capital, then you should focus on venture capital funding. To secure venture capital funding, you will need to build a compelling pitch deck. So download the Innosphere Ventures pitch deck template from the InnosphereFund.com website to get started. Next, identify a list of target investors who invest in early stage businesses in your sector and in your geography. Now, instead of sending your pitch deck as an email attachment to investors, send a link to the pitch deck hosted in the cloud. Links are far more versatile, and you can keep the pitch deck up to date without needing to resend the latest version. Links enable you to track metrics on your fundraising campaign. The number of prospecting messages sent, number of pitch deck views, which sources of links are getting the most click-throughs like email, social, so on. You can track the time investors spend viewing the pitch deck, how much time investors are spending on each slide, and do they make it to the end of the presentation. Other metrics you can track are how many outbound messages and pitch deck views turn into meetings, and how many term sheet offers have you received. You will also need to establish a virtual data room with your supporting materials, like your business plan, buyer personas, customer case studies, marketing strategies, customer analysis, product development artifacts, and so on. The venture capitalists who show interest in you and your company will take you through a due diligence process. Expect this process to take some time. It will be a lot of work preparing the requested materials and having the various meetings discussing certain topics. Once you have made it through the due diligence process, you will negotiate the financing term sheet, usually a convertible note or preferred stock financing. So, what is a convertible note? Well, a convertible note is a short-term debt that converts to equity in conjunction with a future financing round. The investor is loaning the company money, and instead of a return in the form of principal plus interest, they receive equity in the company. The primary advantage of issuing convertible notes is that it doesn't force the issuer and investors to determine the value of the company when the company isn't far enough along to determine a valuation. Now, here are a few key terms with convertible notes. First, a discount rate. That's the valuation discount the investor receives relative to other investors in the subsequent round of financing. Valuation cap. This caps the price the note will convert to into equity. Interest rate. Interest accrues to the principal, increasing the number of shares upon conversion to equity. And maturity date, the date the company needs to repay the note. So here's an example of what conversion to equity looks like. So let's say we have Newco. They used a convertible note for their pre-seed round with a $4 million valuation cap and a 20% discount. Let's say Newco is raising its subsequent round at a $4.5 million pre-money valuation at $10 per share. The 20% discount would result in $8 per share for the note holder, dividing the $4 million valuation cap by the $4.5 million pre-money valuation and applying that to the $10 per share price results in a higher $8.89 per share. So it would be the discount rate that drives the conversion to equity, not the valuation cap. Next, what is Series Seed preferred stock? The venture capital firm is making an investment in exchange for equity ownership in the company. They receive preferred shares, while the founders and company employees have common shares. Preferred shares have a higher priority over common shares for dividends and liquidation. There are some key terms in a Series Seed preferred stock term sheet. First of all, pre-money valuation. This is the value of the company before new capital is invested. Protective provisions. The preferred shareholders must approve certain decisions that are critical to the company. Board of directors. The size of the board and how the board members are selected. Information rights. The preferred shareholders must be informed of material facts, risks, and costs associated with the company. For example, they receive annual and monthly financial reports, as well as updates on progress toward operational plans. Pro rata rights gives the investors the ability to participate in a subsequent round of funding to maintain their ownership position. Option pool, an unallocated pool of stock options to be used for retaining employees. Now, the pre-money valuation determines the equity ownership percentage for the investor. So for example, if the pre-money valuation is $5 million and the investor invests $500,000, then the investor's ownership percentage is 9%. On the other hand, if the pre-money valuation is $7 million and the investor invests $500,000, then the investor's ownership percentage is 6.7%. So there you have it, an overview of how to raise money to start a business. So go to the InnoSphereFund.com website to download the InnoSphere Ventures convertible note and preferred stock term sheets. Once you've established a product market fit for your business and are ready for seed funding, reach out to InnoSphere Ventures and let's see if we can be your partner, helping guide you along your journey to success.